Welcome back to the Capital Breakdown. Today, we're tackling a surprising question. Can owning too many funds actually make you lose control of your money? It sounds odd. After all, we hear diversify, diversify, diversify. But what if there's a tipping point where more funds don't add safety, but just noise? That's the trap of over-diversification, a subtle pitfall many investors fall into, chasing every niche fund out there. Too much complexity can cloud your view, hide risks, and dilute returns. Stick around as we unpack what over-diversification really means, why it happens, and how to clear the fog in your portfolio. By the end, you'll feel confident and in control of where your money's headed. Let's dive in. First, what is diversification? It's spreading your investments across stocks, bonds, sectors, or regions to reduce risk. Picture a fruit basket. If one apple spoils, you still have oranges and bananas. That's the classic idea. But here's the catch. Too many fruits, especially if they're all similar, clutter the basket. Owning 10 funds that all invest mostly in U.S. large-cap stocks might feel diversified, but if they hold the same companies, your risk isn't really spread out. This is over-diversification, owning many funds that overlap so much they become noise, making it hard to see your real portfolio makeup. It's like tuning into static instead of a clear station. That noise breeds confusion, indecision, and missed chances. For example, say you own 10 funds, each with 10% allocation, but 70% of their holdings are the same 20 companies. Your portfolio isn't diverse. It's heavily tied to those companies. If they stumble, your whole portfolio feels it, despite the illusion of spread risk. So why do investors fall into this trap? One big reason is FOMO. The market offers so many options: sector funds, international funds, bonds, small caps, emerging markets, real estate. The list never ends. Chasing every trendy fund feels like covering all bases. Another reason is the false sense of safety in numbers. More funds might feel safer, but real safety comes from thoughtful allocation, not quantity. Imagine owning 20 tech funds with slightly different holdings, but all tech-focused. If tech dips, you're exposed multiple times over. Also, managing dozens of funds gets overwhelming. When everything moves, it's tough to know what matters. This confusion often leads to paralysis or reactive trading that hurts long-term growth. Psychologically, we think more choices mean better decisions, but studies say the opposite. Too many options cause decision fatigue. It's like walking into a supermarket aisle with 50 cereals, exciting at first, then overwhelming. The same happens with too many funds. What happens with over-diversification? One issue is diversification, adding assets that lower your performance or raise risk without reward. Here's why. Spreading money too thin means returns tend to mirror average market performance, minus fees and expenses. Each extra fund adds fees, overlaps, and sometimes weaker holdings. Instead of boosting returns or cutting risk, you chip them away bit by bit. For example, holding 15 funds, each charging 0.5% fees, means paying multiple fees on similar holdings. Over time, these fees compound, seriously trimming your net returns. Over-diversification also hides your portfolio's true risk. You might feel diversified, but be heavily exposed to one sector or market cycle. Without clarity, you can't adjust smartly or plan strategically. Plus, complexity ups the chance of mistakes. Juggling many parts makes it harder to stick to your plan when markets get rough. It's like juggling too many balls. Eventually, one drops, costing you. Now, let's contrast that with simplicity. Think of a well-tuned sports car versus a cluttered garage full of parts. The sports car is streamlined, efficient. You know how it performs. The garage? Overcrowded and confusing. In investing, simplicity means choosing a few well-chosen funds that cover broad market segments without overlap. For example, a broad market index fund plus an international or bond fund can deliver solid diversification with less confusion. Driving that sports car, every part works together smoothly, giving you control and predictable performance. Similarly, a simple portfolio with a handful of funds offers clarity on risk and behavior. This helps you understand your portfolio's risk and return clearly. You can track performance, rebalance, and feel confident about your money's work. Simplicity isn't laziness, it's intentional design, like a chef using quality ingredients instead of dumping pantry leftovers. Less complexity also cuts emotional reactions during market swings. For instance, during downturns, a simple portfolio lets you focus on long-term goals instead of scrambling to analyze dozens of moving pieces. That calm focus often prevents costly mistakes. How to know if you're over-diversified? Start by taking inventory of your holdings. Look beyond fund names. Check actual holdings. Many funds list top holdings and sector breakdowns online. You might find many funds holding the same big tech stocks or government bonds. If so, your portfolio may feel diversified but is really concentrated. Another sign, dozens of funds, but your returns closely track a single market index. That points to overlap and redundancy. Ask yourself, do I know why I own each fund? Does each add unique risk-return benefits? Or am I just adding noise? Being honest is key to cutting clutter and gaining clarity. For example, owning 25 funds, but 15 are U.S. stock funds with overlapping holdings, means your portfolio behaves like a single U.S. stock fund. That adds complexity without benefit. Use online tools or portfolio trackers to spot overlaps and risk exposures. These help you see where your money really is, beyond fund names and categories. Let's talk fees in over-diversified portfolios. Every fund has costs, management fees, expense ratios, sometimes trading fees. Owning many funds means fees add up fast. Imagine paying small fees on 20 funds versus 3 or 4. Those costs can eat into returns over time. Even tiny fee differences compound to thousands over years. More funds also mean more transaction costs when buying, selling, or rebalancing, further eroding gains, especially in taxable accounts. For example, a portfolio of 20 funds averaging 0.4% expense ratio seems low. But combined with commissions and bid-ask spreads, costs add up. Over decades, these fees steal significant wealth from compounding. That's why understanding cost impact is critical. Sometimes consolidating into fewer, low-cost funds with broad exposure is smarter, not just for simplicity, but your bottom line. Think of it like groceries. Buying ingredients in bulk or whole foods usually costs less than many small packets. Same with fund fees. Less fragmentation saves money. Now, practical steps to find balance. Diversification is vital, just not endless expansion. Start with your goals and timeline. What are you investing for? Retirement? A house? Education? Your time horizon shapes your risk tolerance and asset mix. For example, if you're 25, saving for retirement 40 years away, you might favor stocks for growth, fewer funds covering broad markets. If retirement's 5 years away, bonds and stable assets take priority. Maybe fewer bond funds focused on safety. Next, review your portfolio carefully. Identify overlapping funds or those adding little diversification. For example, 2 U.S. large-cap growth funds likely overlap a lot. Then, consider consolidating. Broad market index funds or ETFs cover sectors or regions efficiently, cutting the need for many niche funds. Finally, monitor regularly. Markets change, and portfolios should evolve, but with clarity and purpose, not just adding more funds for diversity's sake. Think of this like gardening. You prune excess branches to keep the plant healthy and productive. Your portfolio needs the same care to stay efficient and on track. Concrete examples. Say you own 5 U.S. stock funds, large cap value, 2 large cap growth, a mid cap blend, and a tech sector fund. Looks diverse, right? But many hold the same big companies, just categorized differently. This is classic over-diversification. You pay fees on multiple funds while holding overlapping stocks. Instead, one broad U.S. total market fund covers large, mid, and small caps efficiently. Or international exposure, owning separate funds for emerging markets. Developed markets, Europe, and Asia adds complexity and fees. Some prefer one global ex-US fund, capturing broad international markets simply. These show how smart consolidation cuts noise, lowers costs, and makes managing easier. If those 5 US funds each charge 0.3%, that's 1.5% total. One total market fund at 0.05% slashes fees dramatically, freeing more money to compound. Another scenario, bond funds. Many pile into multiple bond funds, government, municipal, corporate, high yield, international, trying to cover every income source. But buying many bond funds separately can be over-diversifying or taking unintended risks. High-yield bonds carry more credit risk and volatility than government bonds. Mixing them without clear intent muddies your risk profile. A better approach: a diversified bond fund or a couple with distinct purposes, one for short-term safety, another for income. Imagine holding 5 bond funds: treasury, municipal, corporate, high-yield, international. Without a clear plan, you might double up on holdings or add more credit risk than intended. Know each bond fund's role and if it fits your goals and risk comfort. Overloading with bond funds doesn't always mean safer income. Think of bond allocation like a toolbox. You want the right tools, not duplicates cluttering the box. Choose funds that complement each other and meet your needs. Zooming out, why does clarity matter so much? When you truly understand your portfolio, its makeup, risks, and alignment with goals, you make better decisions. Clarity helps avoid emotional reactions that derail plans during market swings. It empowers sensible rebalancing and steady long-term progress. Investing's like driving a car. You wouldn't clutter the dashboard with dozens of gauges you ignore. You keep key indicators front and center to respond confidently. Over-diversification is a cluttered dashboard. Too many signals create confusion and make steering your financial journey tough. For example, tracking 30 funds with overlapping holdings is like having 30 speedometers showing slightly different speeds. How do you know which to trust? A simple portfolio gives one clear speedometer showing how fast you're going and when to adjust. Clarity isn't just nice, it's the foundation for disciplined investing that builds wealth over time. When markets get volatile, understanding helps you stay calm and focused, avoiding panic or chasing trends. Quick reminder: this episode is educational only, not personal financial advice. Everyone's situation is unique. Always do your own research and consider consulting a qualified financial professional before making changes. That said, these principles apply broadly. Over-diversification leads to confusion, higher costs, and diluted returns. Thoughtful, purposeful diversification, simple and clear, gives you control and confidence. Remember, investing is a marathon, not a sprint. Building a portfolio that's easy to understand and aligned with your goals helps you stay steady through ups and downs. At the Capital Breakdown, we want you empowered, not overwhelmed, about your money. Use these insights to review your portfolio and make adjustments that clarify your investments. If you feel stuck, start small. Consolidating 1 or 2 funds can boost peace of mind and returns. To close, here's a quick recap. Diversification is good, but more isn't always better. Over-diversification hides risks and buries gains under fees and complexity. Focus on quality, broad exposure, and clarity. Regularly check for overlap and needless complexity. Consolidate when it makes sense, using broad market funds to cover asset classes efficiently. Know why you own each fund, understand your risk, and keep your portfolio aligned with your goals and timeline. Most importantly, stay calm and stick to your plan. Thanks for tuning in to the Capital Breakdown. Keep learning, keep questioning, and always keep control of your financial future. Until next time, thanks for watching the Capital Breakdown. Remember, this is education, not personal investment advice.